Claudia, thank you very much for joining us today. We have seen a lot of economic data here in the last few days, so you're the perfect person to speak to. The CPI continues to be very strong. The most recent number came in at 3.5% annualized, including fuel and food. GDP Q1 GDP came in at 2% annualized. And I want to dive into both of these numbers. But before we do that, why don't we just start with a very top-down, high-level approach? What is your overall assessment of the U.S. economy as it stands right now? Are you bullish or bearish?
Oh goodness, confused? No, I mean I'm more on the bullish side than the bearish side, but we certainly have we still have a lot to navigate. And I think until we get more clarity on what's happening in the Middle East and with the energy supply, it's until that is resolved, it's hard for me to be bearish because there's still some pretty bad outcomes on the path. But I will say, looking at the US economy, even and not just AI investment, which is certainly really firing on all cylinders, but the American consumer overall has been pretty resilient. And I think the US labor market overall is pretty good. And that is despite the fact that we've been hit by a lot of big policy changes since President Trump came in to office, and a lot of uncertainty, and just keep motoring along. So I don't want to I don't want to bet against the U.S. economy right now, but I do worry. I think there are definitely risks out there, and you put enough pressure on even a great economy, and it's going to start to show some wear and tear.
And I think you hit the nail right on the head when you use that word uncertainty. We hear that quite a bit from Jay Powell. And but it's amazing how resilient the economy is and also the stock market. And I know the stock market is not the economy, but it continues to climb this wall of worry. Like every day, the S&P and the Nasdaq just keep grinding higher.
Right. And I've described this economy. So I write on a Substack, Stay at Home Macro, play on my last name, Sam. And I have a piece recently about the whiplash economy. Right. So this is it's not just this uncertainty piece, but one of the things that, particularly in the last 5 or 6 years, the US economy and also the global economy to a large extent has just been hit by one supply shock after another. And supply shocks, and these are like the pandemic, which had the snarled global supply chains. We also had a lot of disruptions to labor markets because of the pandemic. People were trying to avoid the disease. And then we have, big energy shocks with Russia and Ukraine, and then now with the Middle East. And in the US, the increase in tariffs. I mean, that's another cost shock. And one that I spend a lot of time because I look a lot at labor markets is we've had huge swings in immigration from a big buildup right after the pandemic to in recent years a really sharp decline. And these are all, and then we're talking about AI, right? We're in the early innings of that, but that's another supply shock. And these are it's like you're rewiring the fundamentals of the economy. The details matter. It's very hard to forecast the time horizons, like how long it takes to adjust to these things. And it can really mess with some of our rules of thumb, like how to read the economy, or for policymakers, how to handle it. The Fed's tools are reasonably good at like demand management. Supply shocks are a lot harder because especially say for the Fed, it puts their dual mandate in tension because a negative supply shock pushes up prices and pushes down employment and growth. And so then there's this tension. And so I just think this has been kind of unusual, the frequency of these shocks. And it gives a lot to kind of think about the structure of the economy. So, and they've been big in terms of, how big the shocks are. So that's been a thing that's really been preoccupying me, is kind of thinking about how to read that whiplash economy.
So you mentioned the Fed a couple of times, and we just had a meeting. So when we started this year, we were expecting, I think, two or three rate cuts, and then here we are a few months later. And of course, what's happening in the Middle East has changed all that. But during the recent meeting, the Fed kept interest rates unchanged. The vote was 8-4. It's the first time we've had four dissenters since 1992. What were your thoughts on what Jay Powell said during the presser?
Right. So the Fed had uh, at the beginning of the year went on pause. They had done some rate cuts the end of last year, some concerns about risks in the labor market. And so, but when they started this year, the labor market looked like it was stabilizing, and there were still concerns. I mean, inflation's still elevated. And I will point out, with today's data, we got the March personal consumption expenditure, which is the Fed's kind of target measure of inflation, and we have now hit a full 5 years of inflation above the Fed's 2% target. Now, we are much closer to the target, kind of running something in the 3% range or a little above 3%. It's not the 9% that we saw in 2022, but it's still above. It's above target. It's above what Americans have been used to. Kind of the pre-pandemic pace was actually a little below 2%. And it does add up. Every year, you're off on inflation, the price level just keeps drifting up higher. So that is that's a sour note, right? For someone finishing up their 10 years Fed chair, I certainly don't blame Jay Powell for all of the inflation. The Fed made some mistakes in terms of probably timing of, raising rates and, not doing the balance sheet expansion quite as long. We would have had inflation anyways, but it's still, that's part of his legacy, is walk away with that 5 years above target. So, but the Fed, even before the conflict in the Middle East, was kind of in this holding pattern. They wanted to see good news on inflation. And the story had been a lot of, and I think it held up with the data, I don't think it's just a story, that core goods inflation, so take out the food and energy, but look at the core goods, it had been really picked up last year. Fits a lot with the tariff story, because tariffs are a tax on imported goods, and often, businesses are going to pass those extra costs on to consumers, and also, tariffs make a less competitive environment. So other companies that don't have to deal with the tariffs, they might raise their prices too. So it very much looks like in the data that core goods inflation is elevated, and pretty notably elevated. And so, but with a tariff, the standard thinking on it is, well, it's a tax, so it's going to fit into the price level. As it's adjusting up the price level, it is going to increase inflation because it's a change in the price level. But if it's a one-time adjustment in prices, which makes sense given, as long as the tariff sits still, and President Trump did move tariffs around a lot, but if once they sit still, you have a one-time adjustment in the price level, and then once that adjustment in the price level is done, then inflation should drift back down. And there's been a lot of research, both at the Fed, other academics, people using, various types of data, and you can kind of see the tariff effects. And we're at about the time where those should start rolling off. Now, this Fed, having been burned by, being transitory pandemic inflation. And again, supply shocks are very hard to forecast. And we also had a lot stronger demand picture back coming right out of the pandemic. But so now the Fed has been very much in a risk management. They have a baseline, tariffs are going to run off, but they want to see it. They want to see evidence of that rolling over on the tariffs before they start cutting rates. So that was the idea of we'd start to see this the middle of the year. I think there's some hints of it in the data, not quite yet, but there's some hints. And then in the second half of the year, you'd have some good news cuts. Like the Fed could say, oh, inflation is bad, we'll start cutting. Well, I mean, the conflict in the Middle East has completely upended that timeline. We are still waiting, and Powell has said this, we're still waiting to see those tariff effects roll off. So the Fed was going to be in wait and see anyways. And now there's the issue of energy prices and having to watch very carefully for any spillovers where it starts seeping into core. And so that's going to take a lot of time to, even once we get to a place where there's some resolution on the conflict itself, it takes time to kind of heal the energy supply chains, get the stuff going. And, it still is a wild card with the American consumer, because after 5 years of higher inflation, the Fed does worry that people are just going to throw in the towel and be like, it's just 3%. We're not going back. And so I think they're very much in a hold position. That was the policy decision yesterday. There's nothing in the evidence, nothing in inflation expectations or kind of regular experience with energy shocks that really says this is going to be the worst case and inflation expectation will be unanchored. We just don't see anything that looks like that yet, but they're going to be very careful and hold. But the vote So it was 8 individuals voting for a hold, 4 voting against the hold in the statements, and one person, so Stephen Myron, who's come from the White House to the Fed, he voted once again for a rate cut. But the other 3 dissenters, they agreed that the Fed should hold, but they felt it was important that the statement make clear that the next move that the Fed makes could be a hike. No normal human being would read the Fed statement and see, oh, the next move is a cut. But the way the statement has evolved and kind of the thinking of it, because it talks about further adjustments, the adjustments they've made so far have all been cuts. And so the Fed still has this messaging that the majority of the members think that it is most likely that the next move is a cut. But there is a growing contingent. I think Powell was saying, the way things are going, it might be a majority by the next time they meet in June, right? The news has not been good on the oil and price front, but the majority still felt like it was okay to kind of signal next move cut, though they're on pause. But there's a growing contingent that really wants to start at least setting it up as a real possibility that there's a hike. So it's a pretty marked shift. And when Kevin Warsh takes the reins as Fed chair, and he is well on his way, he hasn't had his full Senate confirmation yet, but he made it through committee yesterday, is going to be tough, especially if he thinks rates need to come down. This is not a Fed that is positioned to be cutting rates anytime soon.
And you raise a very good point there, because a big job of what the chair has to do is form a consensus. Do you think he's going to be able to do that?
It's going to take time. And, Kevin Warsh was, so I worked at the Federal Reserve from 2007 to 2019. So I overlapped. I remember Kevin Warsh as a governor. He was there from 2006 to 2011. And, he's been there. Like he knows how the institution works. He knows how, he's, he was a policymaker, right? Like he was one of those 12 votes. But, the chair is a very important role. The chair has one vote, just like the other 12 members of the committee. So there's 7 governors. The chair is a governor at the board in DC. And then on a rotating basis, 5 of the 12 reserve banks, which are all across the country, vote. So that's how you get your 12. Every meeting, there's all 19 of them, like talking away with their views. So they really do work as a whole body. But in terms of who votes, there's 12 of them. And the chair only has one vote. And sometimes from the outside, people have this view of like the Fed is the chair, like whatever the chair wants is what they get. And this is really not the way it works. But the Fed chair sets the agenda, is the leader. And of course, if you set the agenda for a meeting, you do have a lot of pull in terms of where the direction the meeting could go in. The Fed chairs often needs to be in constant communication with all of the other Fed officials to kind of understand where they're at, kind of thinks about, strategic, like kind of moving a discussion along. And then the Fed chair has, I'd say, more resources because all of the Fed staff, and there's like 400 plus economists at the board in DC. There's many more like attorneys and like there's just lots of people, but they all report to the chair. So if he has things, he's talked about wanting a new theory of inflation and wants to look at productivity. He has an army of trained to go off and do analysis on questions that he is interested in. So there is there's an advantage to being chair, but it is an institution that people take their jobs very seriously. They're very data-driven, evidence. And so frankly, it's like the world really drives the Fed. It's what's happening, what happens in the Middle East, what happens with that really kind of sets up the possible options. And there's often, outside of a crisis, the Fed is not a fast moving body, right? Like they will change and they will pivot, but it's deliberative, right? So there could be some we might see some changes, particularly maybe in communication or the press conferences. Kevin Warsh has a style that is different than a lot of Fed officials, so we'll notice a change when he takes the reins in June, which is not that far away. But I do not expect big changes in interest rates, big changes in the balance sheet anytime soon. And really, it's going to hinge on learning more about the economy. I think the Fed is really in this wait and see or pause for quite some time.
I'm going to digress for a moment before we start talking economics again, but I'm kind of curious.
Yeah.
Do all the governors get together in person, or do some show up over a video conference or a Zoom call, or how do they do it?
So in the time that I was there, the governors are in residence, right? Like, so they show up, and there's regular staff briefings, regular meetings that they're in. They all have, fancy offices. And I mean, the building, of course, this is what's been part of the criminal investigation. The building is under renovation, the Eccles building, the main board building, but they all have space. And it's a pretty collegial place, like that they can kind of go down the hall and talk to each other. Now, there have been times, I don't know that this is at this moment, but there have been times where people were more remote, like, and in the world, after the world of Zoom, I mean, everything can be done like by having people video into meetings and such. But I think in general, you have people that are present. Now, the Reserve Bank presidents, again, are scattered all across the country. So they're just coming in for, the Fed meets 8 times a year. And so they come in for those meetings. But, there's a lot of discussion. And particularly, I mean, the chair is talking to everybody before meeting. Like, it's not, they're in communication with each other. But yeah, the governors, they're together. It's a big group. So
Yeah. Very interesting. So the other big news that came out of yesterday's presser was that Powell has opted to stay on the board as a governor. It would mark the first time a sitting chair didn't leave the board of governors since Eccles in 1948. And at that time, Eccles was under pressure from Truman to cut interest rates, just like Jay Powell is now. He's under pressure to cut by Trump. But what are your thoughts on this and on Jay Powell staying on as a governor? Is he being political or is he being patriotic?
Right. So first, one little historical footnote. So Truman, in World War II, the Fed had worked with Treasury and the White House to keep interest rates low to help finance the war effort. And as they came out of World War II, the Fed, Treasury, I mean, they're like low interest rates, right? So I agree. Like Truman wanted the interest rates low, and the Fed was trying to get back having control over interest rates because there have been some bouts of inflation. So it is a very similar, like the Fed at that time felt interest rates should be higher than the White House did. And furthermore, it was who should be in control of interest rates? Who should decide what the interest rates were? Again, during the war, there'd been an agreement that the White House Treasury would say what it is. The Fed was trying to move out of it. And in 1951, they did have the Fed Treasury Accord, which said the Fed has control over, like they get to decide the interest rates. But yes, there absolutely are parallels between now and then. And Powell, in talking, this was a big question. People were curious. Was he going to stay or go? The way the Fed works, the 7 governors are on 14-year terms, and they're staggered. That is one of the protections of the Fed's independence, is Congress created these terms that don't turn over every time a president changes, right? Like you gotta wait until a term comes up, and so but the chair is a 4-year term. So you have to you're a governor and then you get elevated to be a chair. And so that meant that Powell finishes on May 15th, his second 4-year term as chair. So he was first elevated. Well, he's so fast. Powell is the end of an era really for DC, but Powell was actually put on the board by President Obama. Powell is a Republican, but this was back in the time where at the Fed there was often kind of a cross-party. This, again, is something that's completely disappeared from DC. But Powell was put on the board by Obama And then it was President Trump in his first term who made him chair and immediately regretted making him chair. But he did make him chair. And then he was renewed by President Biden. So Powell has this very interesting, like a cross-party kind of setup, but he will finish on May 15th as chair. But his term as governor, because his 14-year term, is not done until January of 2028. So, I mean, he's on the clock. Like, he can stay legally. He still has a position. It won't be chair after May 15th. But typically, traditionally, chairs, once their chair term they have left to give space to the incoming person. But Powell's staying, and he was very clear that he is only staying because there are some, loose ends with the investigation regarding the building renovation. There have been some really unusual efforts by the White House to pressure the Fed to lower interest rates, and he's going to stay on in the spirit of, protecting Fed independence. So, and again, this is very similar. Eccles had a similar theme to it. I will note that Eccles's name is now on the Fed building. I mean, this was a big deal what Eccles stayed to do. So we'll see if Powell gets some real estate named after him many years in the future. But he was also extremely clear at the press conference, and I absolutely believe him that he will follow through on this, that there is only one chair. When his position as chair is done, he is no longer chair. He is a governor. Kevin Warsh will be chair, and he will be there to be supportive as a colleague. Like, he is not staying because he's concerned about the direction of monetary policy or the balance sheet, or he wants to get in the way of Kevin Warsh, because he could if he wanted to. Like, Powell is very popular at the Fed, but he's like, I'm not going to do that. I'm just here to see through some of the extraordinary pressure being put on the Fed. And I think that's really smart for a lot of reasons, but it comes with a risk too. Like, not everybody's happy about Powell staying. And if it provokes the White House more and something else happens, it's not without its risk, but I think it'll, and hopefully it'll resolve, and it'll be a really great day when Powell says, I'm ready to retire. It's okay. I can go now. I'm really hoping for that. So we'll see.
You mentioned that Jay Powell's legacy is going to be the fact that inflation stayed above the 2% target rate for 5 consecutive years. I can't believe it's been 5 years. But do you think 2% inflation is a thing of the past? Are we ever going to see it again? Or maybe is 3% the new number?
Yeah, this is where you and I talked about in the beginning with the supply shocks, right? And any given supply shock, as long as it's kind of within bounds, it's a hit to the price level, pop to inflation, but it ought to be temporary. But if you get really bad supply shocks, and the pandemic really was a mess, I mean, globally it was a mess, or like what we've seen in the last so many years, you get a rapid succession of lots of shocks. Well, then you get a bunch of them and they all push up. I mean, then inflation looks like it's just running higher because you've had a succession of shocks. But as I said, with the supply shock, you're rewiring the economy, right? There's nothing, 2% inflation target, one can debate the history of it, but in a lot of ways, 2% was chosen because that's kind of where the economy had settled. Like, that was, it was a reflection back of, it looks like in normal times when things are going well. I mean, this is kind of into in the 90s or early 2000s. I think that's kind of what inflation was. If you average it across so many years, it was 2%. In the United States, and actually there are a lot of countries, kind of peer countries, that 2% kind of just look like where the economy wanted to settle. And then it's like choosing that as a target kind of reinforces, and there was a, and I don't want to act like, it's a supply shock, the Fed or a central bank can't react. That's not true. I mean, you can pull demand out of the economy even if there's a supply, so there is an aspect of, I mean, Kevin Warsh likes to talk about inflation is a choice, like a very monetarist kind of idea. And you can choose 2%, but But if the economy kind of tends to that, it's a lot easier than if the economy is tending to 3%. And the discussion about a target is a really fraught one to have when you're off the target, because it can feel very much like a moving the goalpost. But I think it is useful for us to at least kind of understand, like as one example with the not just with the tariff trade wars, but I think there've been other pieces of like how we think about global supply chains. One of the reasons inflation has been low, like the core goods inflation, as I was talking about before, like is we opened up trade, and there was a lot more trade for the US. It was particularly important when we started having a lot more trade from China that was helping like push down consumer good prices. It's not the only thing that was pushing down prices, but it was in the mix. And if you start reversing that, well, like that, can you get the 2% if you don't have that constant kind of pulling down on inflation from cheaper and cheaper goods? So I think it's something that we do have to keep an eye on. I think, over time, there are some countries that have gone to something that's more of a range, looking at something that's not as precise on 2%. But I don't think that really gets at this question of what's good, like what's a reasonable thing to shoot for. And and I will say, like I emphasize, under Powell we've had this 5 years of elevated inflation, but inflation also came down without a recession. And we came down from really notably elevated inflation in 2022, and there were a lot of economists, these words never came out of my mouth, but plenty of my peers, that were like, the only way to get inflation down is we have to have a recession. And, we didn't get inflation didn't come all the way down to the 2% target, but we have not had a recession. I mean, the US economy, whether you look at the labor market, you look at inflation adjusted consumer spending, I mean, a lot of metrics of how we think of like well-being, like the broad aggregates, it's really impressive. So then it's, and the Fed, not all central banks have this, but because the Fed has an explicit dual mandate, there is an aspect of trading off between the employment side and the inflation side. The Fed has been explicit about a 2% target on the inflation and doesn't have kind of an explicit on the employment side. And really, the inflation is very focal, right? But there is still this idea of like a 3% inflation. Is that really worth a recession? Like, and I think the Fed in the last 2 years, when they've done their cutting cycle, it is stepping in because they got worried about the downside risks to employment, and they were going to protect that, recovery. So these are all really, these are super difficult trade-offs to make. Even if you have like great data and understand what's going on, then it comes down to a value, kind of a judgment. And I think the Powell Fed over time, and both learning by doing, learning from mistake, I think has gotten to a place where this kind of risk management, follow the data, like I think this is a good way to approach these supply shocks. But it's too soon to really write the verdict on this, because you might come back and say, well, no, those economists were right. A recession really would have been smart. Let's just get that down to 2% and reset the clock. So that's not my view, but I think it's been certainly an interesting time to work through.
So one of the big things that's leading to all this uncertainty in the economy is with what's happening with the oil price and what's happening in the Middle East. And no one has any idea on how this is going to be resolved. But even though energy is a small component of the CPI, we still see a lot of negative headlines associated with it. Delta came out and said that they're going to have to spend an additional $2 billion on fuel in Q2. I'm sure all the other airlines are saying the same sort of thing. Amazon, FedEx, UPS have all said they're going to start imposing surcharges. Do you think, like, if we continue to see oil trade at $100 or above $100, what kind of negative impact will that have on the economy and also on consumer spending?
So with the U.S. economy, with the higher energy prices, you gotta be careful because there's a lot of moving pieces. Let's start with the consumers. the staying kind of like seeing these oil prices somewhere between the 100 range kind of this will be, I mean, it's going to be a weight, kind of a downdraft on consumer because it does cut into disposable income. Energy, or say gasoline, is kind of the most direct energy good that's being affected. And in the U.S. we saw national gas prices, I think as of yesterday, were at like $4.30. In the month of March, they jumped by a full dollar. So, I mean, it's not just the level. Like, these aren't historically, like, really outrageously high levels, but things moved really fast, right? So, like, things have moved up, and it's not clear we're done with this, right, in terms of oil prices moving higher, which would show up in gas. So at this point, it's not like this kind of these type of gasoline prices, even if they were to go on for months and months, this is not a bring the economy down kind of price level. I think oil prices would have to go a lot higher and stay higher longer. And I think some of the market reaction after the first ceasefire was a kind of, oh, the worst case scenarios are much less likely now. Like the kind of mass destruction of the energy supply networks in the Middle East. That seems less likely that we're going to kind of grind through this. But it is still just first on the economic effects. I mean, it is, the gasoline, this is not a negotiable for most people. Like, you got to get to work, you got to pick your kids up at school. So that means that when it's like money just flying out of your wallet, right? So you're going to have to adjust somehow. And for, many Americans cut it pretty close by choice or by preference in terms of, money coming in, money going out. So if they're paying more for their gasoline, it's going to cut into other kind of discretionary purchases. Some people just can work through it with their savings, but it should have a hit to spending. So far, I mean, we've only really got the March spending data. It doesn't look too worrisome. I mean, things are still holding up, but like 1 month in is not enough to understand the response. But it should be a drag for consumers because it hits into their disposable income. But again, I think it's within what's kind of manageable. But gasoline is a very kind of in-your-face price in the U.S., so it has a lot of political. Like, it's a very politically charged price. And this year in the fall, we will have midterm elections. And so $4, and, there are parts of the US that are already up at $5. California is at $6. I mean, because there's variation because of the taxes across the gas tax across the country. But I mean, people are already pretty unhappy, right? And the consumer sentiment surveys really show this quite clearly. So I think that adds to the complication for like the White House, that they're going to have to, these are prices people respond to. And then, as you said, like the energy prices, the diesel fuel prices in the US have gone up even more than, gasoline has. And that there's some consumers that use diesel, but it seeps into all of these other, freight costs, some of the packaging costs, like it can show up. And that's the piece that the Fed, other central banks, kind of trying to look for these where it's bleeding in. Now, historically, frankly, the reality of the economy over many decades is we've had energy shocks from time to time. So there's a lot of evidence to look at, and that seepage has tended to be pretty modest. So unless you get a really big energy shock, you're not going to have really big broad-based shocks, but things like airline ticket, like there are places where, I mean, we can already see it in just the March data, and they will have an effect. So that's all on the consumer side. It is not good. It is a negative, though I think it is one that we will push through. The US, because it is a large energy producer, does have something of a buffer relative to some of our other peer countries. there is a plus. When energy prices are higher, that tends to be that's very profitable for energy producing firms. There aren't many signs right now that we've had a big step or any step up in energy production, but that could happen, particularly if it's prolonged. And that kind of gives economy wide something of a buffer. But like most Americans don't hold energy stocks, so like they're not better off from this. But it does make the I mean, it's the US is more insulated from the negative economic consequences of this shock than probably almost any other country, and kind of started this. So it's kind of an unfortunate, but the US is not spared from it, right? The price effects are there.
Well, I think to your point, because you see it every day, you know what the price of gas is, it becomes like perception becomes reality. And I know that's the case with me. So I'm based in Toronto. In January of this year, I was paying $1.15 Canadian per liter. Now I'm paying about 175, $1.80. If you do the conversion, that works out to $5 a gallon, which is getting up there, right?
Mm-hmm.
Not as bad as the state of California, thank God, but it's getting up there.
Yeah. No, and people do notice it. I mean, it really is the one price that we are most exposed to. And certainly in 2022, after Russia invaded Ukraine and the gas prices started moving the US, I mean, that really was at a point where the switch flipped with the Fed. Because they're like that's it, not only was inflation going, but it's like this is spreading and it's so salient. That's the place where that kind of the inflation expectations going unhinged. And so yeah, it's a and for anything in the US, like it had been one of the selling points for the administration, how low gas prices had been. And that really that disappeared really fast.
So let's move on and talk about the unemployment rate now.
Mhm.
I guess we're going to see the April unemployment numbers here in the next couple of days, but the last number we saw, the unemployment rate was at 4.3%. It continues to tick higher, but historically speaking, still relatively low. But what's your take on the jobs numbers? Are you concerned? Do you think we're like moving toward a normalization period? Maybe we overhired during the pandemic and now we're stagnant in terms of hiring?
Yeah. So the unemployment rate at 4.3%, and it's been, on balance, pretty stable since last fall. So it's a low number historically. I do like to point out we have an older workforce, more educated. So like there's like it should be. Like this is really it's a good number, and it's a pretty appropriate kind of, the Fed doesn't have an exact number for maximum employment, but if you look at demographics, this is pretty much like where you would want to be. Now the unemployment rate has risen since it's low after the pandemic, and it's a little unusual. Again, I think the soft landing, the getting inflation down, the Fed was, the 5 percentage point increase in the federal funds rate, it did cool off the labor market. So, I mean, we can see some signs, like I said, of the unemployment rate drifting up. And historically, it's unusual as much as it's drifted up without a recession, but it happened very gradually, right? So, and again, at 4.3% where we're sitting now, this seems like a labor market imbalance. Now, there's a couple things going on that have, as Powell has referred to it as a curious kind of balance. So one thing that has been pretty notable, and this has been going on for at least the last 2, maybe 3 years at this point, is the hiring rate is low. It's low relative to the pandemic. It's low relative to history, and that's clearly not. If you are looking for a job, if you're coming back into the labor market, if you're among the few that have lost your job, and look, like this is really a tough labor market. But the layoff rate is very low, which is great, right? So if you have a job and you like your job, this is a really good labor market. But this low hire, low fire labor market is unusual. Like that's not a typical one. I think of it as, I like this point, like it's kind of a vulnerable one, because if something bad were to happen in the world, and sometimes it seems bad things happen in our world, and it actually gets companies to the place where they need to lay off workers. If we would have an increase in layoffs in an environment with such low hiring, the unemployment rate would start moving up very quickly. Now, that hasn't been the case. And again, we got more confirmation today. The unemployment insurance claims, which is a very like kind of broad measure of people that are being laid off, is really low. The initial claims are very low. So, I mean, again, we're just not seeing these layoffs, and that's a good thing. But we have this kind of bifurcated labor market in a way that's unusual. Again, low hire, low fire is not a typical, we don't see that in history. And also I find the low hiring rate kind of puzzling given how much, GDP is chugging along businesses or, so it's a little like, there was a lot of churn in the labor market after the pandemic. There was a lot of moving workers around, and it could just be that we ended up with a lot better matches. Or like I said, there were certainly some industries that kind of did overhiring. Like tech really kind of like, oh, the world has changed. We're all going to be online. Like there was just a lot of tech sector hiring. And now, at least to some extent, some of the headlines about, oh, we're doing layoffs because of AI are really, they're doing layoffs because they overhired, right? And they're right sizing. And we have a new technology that helps them kind of do the right sizing. So I think there's been we've had a labor market that was really firing on all cylinders, had people moving around, wage growth, and that's not where we're at now. People are kind of hunkered down. Wage growth has slowed, but it's still good, right? Like on bad, like it's still a good labor market. Now the other thing I'd say about the labor market that has a development, and this really is the last year or so, and it fits in our kind of supply shock discussion, is because immigration has slowed so dramatically. This did start at the very end of the Biden administration, but certainly picked up since President Trump took office. Net immigration. So there's less immigration into the country. There's movement. There's deportation. There's people who are don't want to be here and are leaving. But that in addition to the fact that we have an aging population, has meant that the growth in the labor supply is like just vanished. And so we're not, so if you don't have people coming into the workforce, well, you don't really need to be creating jobs. So we've had several months, about 40% of the time since the beginning of last year, the monthly payrolls have declined. And to have that like frequency of declines in payrolls, that's like what you see in a recession. So you see these numbers and you're just like, whoa, like this is are we about to fall off the cliff? Is a problem? And it's like, well, actually, if your labor supply is basically flat, so you don't really need to keep the unemployment rate constant. You don't really need to be creating many jobs. So kind of good in terms of monthly payrolls is pretty close to zero. Well, then, you have weather happens or there's a strike or there's seasonal adjustment. There's just noise in monthly data. And so what that ends up happening is then we kind of bounce from like a month of declines to a month of increase, a month of declines, increase. So you get this kind of a lot of these negatives are just because, like good is basically zero. But a low labor supply growth, like first of all, we haven't had that in the United States, and second of all, it has implications for what's a good payroll number. It has implication for what's a good GDP number, because like big picture GDP growth is growth in the labor force and productivity growth. And if you don't have growth in the labor force, it's got to all come from productivity, or we're going to have a conversation about how like 0.5% is a good GDP number, right? So like there's a lot that's things are happening under the hood. The labor market's in a good place, but it can be hard to read because, again, these rules of thumb, like, oh, a negative payroll print is a sign of a recession. That is not what's happening, but it's a sign of something like low labor supply. Like that's a really big shift. So lots going on in the labor market.
Claudia, one of the things you're well known for is that you created an indicator known as the Sahm rule. What exactly is that, and what is this indicator telling us right now?
Yes. So I created this indicator. It's an indicator of recession, so it's supposed to tell us like we're in a recession. Not in the recession forecasting business. There's a lot of people in that space. What it does is the intuition for it, and this was something, I mean, I very much picked up as a forecaster. Small changes in the unemployment rate are bad news, right? There's no level of the unemployment rate that says recession, not recession. We've gone into recessions in the United States with 3.5% unemployment. We've gone into them with 7% unemployment. So it's not about the level, but changes are like if the unemployment rate starts to increase, and it can be a pretty modest increase, that's bad news. So the historical pattern, and I did this analysis in 2019 as a project of kind of doing automatic stabilizers and how to improve fiscal response to recessions. So the formula that is just to look at the national unemployment rate, take the 3-month average, smooth out the bumps and wiggles from monthly data, look at the 3-month average, compare the current value to the low of that series over the prior 12 months. If you have a 0.5 percentage point increase, again, this is a modest, right? 0.5 percentage point. But if you have a 0.5 percentage point or more increase, you historically have been in the early months of a recession. And again, I put this together in 2019, and it's not perfect. There, like back in the 50s, there were some times, but from 1970 to 2019, it worked every time. It didn't trigger outside of recessions. It always triggered in a recession. Now, frankly, triggering in a recession is not that hard because in a typical recession, the unemployment rate goes, well, in even the mildest of recessions, like in 2001, the unemployment rate went up 3 percentage points. Right. So eventually in a recession, the unemployment rate will go up. And of course, in some recessions, it's gone up a lot more than 3 percentage points. But the idea is, because again, I was trying to do thinking about a fiscal policy to help in recession, you want something that turns on as quickly as possible and yet as accurately as possible. But the Sahm rule fell victim because I talked about kind of rules of thumb that supply shocks mess with, and I talked about the declines in payrolls. The Sahm rule fell victim to this in 2024 because we did have a 0.5 percentage point increase in the unemployment rate. So the Sahm rule triggered in the summer of 2024. And part of it, and I had talked about it in the months running up to it, but part of it was that was a period where we had the surge in immigration. And I knew this even when I put it together. An Achilles heel of anything using the unemployment rate is it's the unemployed out of the labor force. So you can have, if you have shifts in the labor force. So a good news reason for the unemployment rate to go up is if you have an increase in the labor force, it takes some time for people to find jobs. And so on the other side of that, it's not a recession. It's even more growth because you have people have gotten the job. So there was some, and the other piece was coming right out of the pandemic, which was in the look back for the Sahm rules. We had labor shortages. The unemployment rate went really low and kind of not, I don't call it artificially low, but I mean lower than the economy really could bear because we had these shortages. So there were, these shifts in the, but it's one, and now because again, the immigration is reversed in the other way, the fact that the labor force is growing so slowly, labor force participation rate has come down, it's actually putting downward pressure on the unemployment rate. And some people have talked about as well, we should strip that out and be worried about a recession. And I don't have that view. Again, I just think that we've got under the hood, there's a lot the kind of structure of the economy and the labor supply. But it just shows that a lot of the rules of thumb, and the Sahm rule wasn't the only one, the yield curve took it on the chin, that in 2024 as well. It's just when the fundamentals are shifting around, our rules of thumb, particularly rules of thumb based on demand shocks, which is a lot of what recessions are, right? Sometimes there's a contributing supply shock as a factor, but usually it's some income shortfall, crisis of confidence, something like that. And those rules of thumb just don't quite work. Now, I still like the idea of automatic stabilizers, the idea of putting fiscal policy tied to economic conditions and not political whims. But I will admit that having rules for rule-based, it's hard to find rules that are always going to work.
Well, especially if you go through a period like we've seen in the last 5 years where the government's just pumping trillions and trillions of dollars into the economy, there's a lot of, I guess it creates a lot of upheaval, right?
Yeah, absolutely. And I think, the with these kind of fiscal rules we were trying to develop, it wasn't just about turning stimulus on in a recession. It was also about when would you turn it off, right? Because there's a lot of these temporary programs and trying to tie, like in the US, we often will do extra jobless benefits in a recession. And generally politicians can agree, like, let's send money, like, we're all Keynesians in a foxhole, right? But there's then a huge political debate about when do you turn those programs off and do you tailor them to local conditions. So I think like I said, I still think these policy rules, and that's why it's called the Sahm rule. It's about a policy. It's not like a rule of the economy. It's like trying to tie policy, but but it's really hard to characterize an economy that's always, as dynamic as it is. I mean, that's a great problem to have, a dynamic economy, but I do think it's like trying to get some even if it doesn't take the discretion entirely away from policymakers, just give them some good guardrails or just more guidance, more kind of concrete guidance. So
Jamie Dimon was speaking at the Norges investment conference recently, and he stated that he's very concerned with the federal debt levels, and he thinks they could trigger some sort of crisis in the bond market. And I'm curious if you share his concerns. We got the 10-year trading around 430, 440, the 30 years approaching 5% if it's not already there. But do you have his concerns like we could see some sort of crisis in the bond market? And if so, what would that look like?
This concern about federal debt levels. This has been ongoing for many years now, and I think that's like what would the crisis look like? What is like I don't have the crystal ball on this one. What I will say is like in economics, there's been research over time trying to like what's the debt to GDP ratio or what's the debt service to GDP rate, like trying to figure out like at what point is this a problem, right? Like at what point do we really go past the point of no return? And I think the US, and we're not the only country, but it's like if you issue debt in your own currency, and I think it could be pretty far out there, right, in terms of like how much debt could be taken on before things really fall apart. Though borrowing costs are going to put upward pressure on borrowing costs for sure. I guess with the U.S., I often come back to, as opposed to thinking about a particular level of debt or getting exercised about these massive amounts, like go back to like, why do we have this debt, right? In the US, if you are concerned about the federal debt and debt sustainability, like it comes back to, we have entitlement programs, our old age programs, Social Security, Medicare to a lesser extent, but also Medicaid. It's like health insurance for lower income individuals. Like those entitlement programs are the one that keep growing, because again, it's the aging population. Like the U.S. is not unique in this, but it's kind of like you can't fix debt sustainability by discretionary fiscal program. Like there aren't enough programs for the poor in the United States. There aren't enough programs for like education at the federal level that you could cut all of it and we still would have this federal debt like on a trajectory that is worrisome. So to me, it's like, okay, but entitlement reform is extremely politically thorny. And the idea, is kind of like, we should be talking about that. We should be trying, like, if you're serious about debt sustainability, you got to be serious about this kind of, what do we do with the entitlement stuff? The politics, economists have, for like when I trained as a research assistant in 2000 at the Brookings Institution, we talked about like the economics of how you fix Social Security are really straightforward. The politics of how you fix Social Security are just like immensely difficult. And so it probably will take some kind of a crisis to get to get politicians to actually make the changes that make the debt sustainability. But one could hope that we could avoid that and like actually go at why is the debt, and it's not just entitlements. Like there are other issues in terms of like the fiscal space, but to me, I'd rather do kind of the bottoms up. Like, what are we doing with this money? What are these programs? What can like and fine tune them as opposed to there's some GDP level or debt to GDP level, which it's going to fall apart. But I do think, kicking the can, not having these conversations, not going in and like working on the policies themselves. Well, yeah, as time goes on, the risks go up and it'll be very messy. And with a lot of the entitlement programs, the kind of the fixes that you would do, the sooner you do the fix, the less painful it is. So like the longer we wait to make adjustments to like Social Security benefits, either the benefits or the tax, like we're gonna have to do more. So it's a frustrating situation. But like I said, I tend to go at it from the nuts and bolts of what's in the debt as opposed to the financial market blow up. But I can. We are at levels where, I share the concern, but I don't see the signs, any imminent signs of it in even like say looking out at 30-year bond. Like it's really hard. It's hard to see it. But I do agree that at some point, confidence can be lost pretty quickly, especially in markets.
So just to summarize a lot of the points we touched on, it sounds like overall you're, I guess I should say, optimistic about the economy. You're more positive than negative. Do I have that right?
Yeah, and I think, and especially the longer the horizon is, I'm optimistic. I am I'm certainly I am optimistic. I think we didn't talk really at all about AI, but I think that's one where there's some positive productivity in train, and I am worried. So if I look at all the economic stuff, I say pretty positive. I think we're going to push through this resilient economy, there. But I do worry we've had a whole series of shocks, back to my whiplash economy. And it's like each one of them in isolation, the tariffs, the gas price, like we can muddle through. And so far we have muddled through them. But I get worried about the layering, like the frequency and the also just very big picture uncertainty, right? I think in the US, the economy has people have really pushed through what I think has been a kind of extraordinary amount of policy uncertainty in the last year. The President Trump, part of his approach is kind of shock and awe and move fast and break things. They've said that, right? Like that's just it, and there is a logic to it. It's not one that I embrace. I think it's a very risky. At this point, we've kind of navigated it, but I do worry that it can wear down institutions. So like with the Federal Reserve, I think the pressure the White House has put on the Fed to lower interest rates, I think has been incredibly counterproductive. I don't think Fed Governor Lisa Cook, the president trying to fire her, and a criminal investigation of Fed Chair Jay Powell. This is not good. This is putting a lot of pressure on the institution. Up to this point, the institution has continued to do monetary policy as usual, like following the data, doing the best they can. But I do worry that institutions, and the Fed is not the only institution under pressure, but institutions, if put under enough pressure for enough time, will break. And the fact that we are even having those conversations makes me really worried, right? Because the institutions, like the foundation of the economy, rule of law, institutions that work, like those are being tested. So so maybe I'm just a very bipolar view here. Like if I look at kind of the regular stuff and I kind of look at and I'm very, very pro American business, American consumer, like don't bet against the American consumer. They if they can, they will go for it. But then when I think about some of the institutions that like it makes me worried. Like there are some so basically positive, but with a very wary eye on some of the things that are happening.
Well, Claudia, this has been a great discussion. I want to thank you very much for spending time with us today. If some of our viewers would like to read more about you or see some of your research, where can they go?
Yeah, thank you. And it was a joy to be here today. So I have, as I mentioned for a Substack, Stay at Home Macro Som. That's one place. And I do write pretty regularly on Bloomberg Opinion and show up on LinkedIn some. So there's plenty of places to find my ideas. So.
And I will make sure I include those links below in the show notes. Claudia, once again, thank you and good luck in the markets.
Great. Thank you. You too.